grow.
We spoke a little bit about the parallels between the Asian financial crisis and you'd spent some time in Japan, where arguably they set the bar for long-term economic crises. Maybe you can elaborate a bit on that and your views on that, and just considering some of the instability that's going on in the West, in Europe in particularly of late, is it worth investing in Asia and China, for that matter, alternatively?
I think the first one relates more to the this deleveraging we talk about, because there was a credit bubble in Japan in the late 1980s. There was a credit bubble in Asia as well prior to the Asian crisis. We have had the same thing in Europe and in the US for the last 5 to 10 years. And now we are facing reality. We went from drug addiction to detox situation. And this is something that, of course, is very painful. Also something that, based on the Japan experience, is lasting much longer than what anybody would expect. So we have to be ready as investors for a scarcity of capital. That will be the condition for investing, I think, for, is it another 5 years, 10 years, 20 years? Honestly, I don't know. I don't have a crystal ball like you, but I wish I could predict exactly the duration of that deleveraging process. But for sure, I expect this to be very, very long and very, very painful. However, I see also some positives there. In a form of scarcity of capital means maybe more rational allocation of money and to have some discipline. When I look at, and this is where we can draw the parallel between Japan, US, Europe, and Asia over the last 2 or 3 decades. Asia had a credit bubble in the 1990s and went out of that without having governments going into much heavy debt, while the private sector, whether it was household or corporates, did pay back the debt over the years. In the case of Japan, in the case of Europe, and in the case of the US, definitely we have seen actually the private sector deleveraging and the public sector increasing borrowing. And if you look at the ratios of debt to GDP in places like US, Europe, and Japan, the levels are very high compared to what Sean showed us earlier on Asia. So this is the contrast I would make from a deleveraging process and what it means. Now, you were asking me about the investment opportunities, and no doubt that what we have enjoyed for the last 20 years, 30 years, a big bull market, the party is over. I mean, I don't think I need to tell you that. And we need to find new ways to invest. And there's been a game played by many money managers over the last few decades, which is asset allocation between equities and bonds. You know, when you see the stock market offering some good prospect to put more money into equities, when you're not too sure about that, you find your rescue into bonds. But I would expect that if we assume no more bull markets for maybe a decade or two, and again, the roadmap from Japan can be a good lead there. If we get that kind of scenario, then the asset allocation game has to evolve. And it has to evolve from a traditional risk-taking, risk-aversion standpoint to a more, I believe, more selective approach, finding opportunities where the market, the beta, will not rescue you. And I think to some extent we'll see alpha generators, money managers emerging as the true winners of this environment, while those who have just been surfing on the beta wave for the last 2 or 3 decades will have a hard time in surviving looking forward.
Li, beyond the narrow scope of Asia finance, are there other sectors you see benefiting or suffering from the European fallout?
If kind of follow up on Bennett's answer as well, question as well. So 2007, I sold even my own house, and late last year started to buy, U.S. housing, rental house property myself. So I think that's something you can do as well, right? And if Greece get out of Eurozone, that would be the country. If you have all your money, put it there. After Greece get out of Eurozone, and if you don't believe it, you can see the numbers. They will give you one of the best return over the next 10 years. Okay, once Greece get out of Eurozone or Spain get out of Eurozone, that's a fact. It will happen. And myself, all my money, every penny of it in 2008, I put in long-term T-bonds, 20 years plus. So, it was more than 30% return that year for me. And March 09, 9th and 11th, most of my money started to get into high yield bonds. That was, sort of like what I say. I did do that, and I have friends who know that I did that, because they're following. So going forward, I do think there are things that could improve, could make money. Even if you look at China, China, for example, look at the Japan's experience. It might be, everything is a bubble. If you buy Japan from the height of 1990, actually you still don't make any money, whatever sector you buy today. Until today, you are losing money big time. That's if you do some analysis across industry, for example. But if you bought at certain kind of, not the very, very bottom, but during the volatility, you could buy at the relative bottom in certain sectors. In Japan, you could have made a pretty decent return over the last 20 years. Okay, so that is some lessons to learn as well. I think even in China, when we look at you would have things to do. And just look at my predictions, right? So early last year, I said you can basically buy U.S. SP 500 index fund. You can short any of the ETF, let's say China, Hong Kong, Russia, Brazil, or Australia. And last year, you would have made 20% return. This year, if you do it selectively, you would have made 5% to 10% return. And next year, I emphasize, next year and the year after, you'll likely make at least 1 year, 20% return again. Okay? Because nobody has, in general, has, get used to the concept that China would slow down to the extent of 3 or 4% a year. This year I was in Zhejiang province. I haven't stepped into China actually for 6 years until that date. But I think I know the macro level pretty well. And I talked to friends and all that, and I did know, like in China's Zhejiang province, the actual GDP growth in the first quarter of this year was 4.1%. Okay, 4.1%. Even though the official number was 7.2%. Okay, it's 7.2%. So it's 3.1% difference, huge difference, in the official reported number versus actual number, and it's already happening. It's just people are not realizing it yet. Usually GDP doesn't necessarily correlate with the stock returns, but in this kind of case, when average people or the majority of people don't realize how much slowdown China is going to happening, that in that sense you can still make a lot of return. You can mark my word. If you made money from this, you can invite me for lunch in the future. Don't worry about it. If I have time, of course, right? If I don't have time, then so I think there are a lot of things to do, to potentially invest. Just you just need to find your exposure and don't step on, because this whole China model, growth model, and also everything related to China's growth model, as I said, Brazil, somewhat, Australia, all those mining sectors, all those things, Russia will have big trouble, and things like, for example, Australia dollar probably will depreciate by 20% or so going forward, but that will help Australia's other sectors, which has been killed by this Dutch disease of the mining sectors. Okay, once Australia devalued substantially, 20–30%, the other sectors of Australia will become attractive again, and that's where you can put your money on, and you can retire like Paul someday quickly.
We talked a little bit about the government, the sort of policy measures that the government should be putting in place before the session started, and we've mentioned a few steps that need to be taken. You mentioned something that it's not just government regulation that's needed. It's actually a mindset shift that needs to happen. Care to elaborate on that?
I think one of the most important things to note when you talk about sort of bonds, and it comes to this issue of corporate governance and things like that, is that the bonds are not a publicly tradable instrument. Normally they're traded bank to bank or person to person. They're not traded on the stock exchange. And the issue you have throughout Asia is that the legal systems to enforce bondholders' rights by and large are imperfect. And the reason why you have no defaults in China is because there is no recourse to law to be able to force yourself into a situation where you're able to recover your money. So as a bond investor, if we look at the issues around not so much systemic risk, but around market risk, the biggest issue in the fixed income markets are that wherever one looks in Asia, I'm not singling out China, but wherever one looks in Asia, you have legal systems that to an extent are not perfect in terms of being able to enforce bondholder rights. And I think that's a key issue. The other thing I think that Sean's chart showed as well is particularly that slide about margin compression, things of that nature, is just how uniform Asia has become as well, is that the differential between buying a Vietnamese credit and buying a Hong Kong credit is much, much less in terms of the risk premium that you would attach to lending money into a Vietnamese company than lending money into a Hong Kong company. And I think that's another thing that everyone has got to start to look out for. So I think the risks are building up in the bond market. People are raising money, and again, we shouldn't delude ourselves. Why are people raising money in the bond markets? Why are bond markets exploding? It's because they can't get IPOs away as well, which is the other part of the whole equation. If people can't raise money in the equity markets, then they're going to raise money in the debt markets. So that's one other factor that I think one needs to be aware of what the motivations are behind fixed income raising. In terms of the mindset question that you asked, I think that's the important thing that I think we all need to focus on is that has anything really changed in the world's financial system in the last 5 years since the crisis erupted? And I think one has to answer, unfortunately, a rather bleak no. And I think that cuts at some of the things that Benoit and Sean were talking about the length of time this is likely to take to get out of this recession, because the people who are in charge of the world's financial system are essentially the same people who took us into the crisis. And no amount of regulation is going to change that. It's a bottoms-up educational issue that we have to get back to the future, really, before the world's financial system can become healthy again. And that's all about educating the new generation, which is why I'm delighted to be here and why I'm delighted that we're here with HKUST. It's all about educating the new generation of finance professionals to behave rather better than their parents behaved. And that, I think, is going to be the challenge for the next 20 years, because this is going to be a protracted recession. There's going to be a lot of turmoil, a lot of blood on the streets, a lot of companies that aren't around in 10 years' time that are around today. And the people that are in charge of the financial system have to be changed before new behaviors can come out, before we tackle the issue of agency principal risk, and before we get back to the situation of putting our clients' interests above our own. And I don't see much changing until we get to that position.